Tough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
By December 31, 2022, Silicon Valley Bank held $209 billion in assets and $175 billion in deposits, according to regulators. How did such a big bank fail in such a short time? It served businesses and even venture capitalists, and after it was founded in 1983. It became the largest bank in Silicon Valley based on local deposits. And it was also the 16th largest bank in the United States. More importantly, SVB was a leading banker to some of the most successful startups in the US. In fact, reports say that it even catered to companies like Airbnb, Fitbit and Pinterest. In simple word, last week with Silicon Valley Bank runs happen. Because of one fundamental fact about banks: your bank does not have your money.
The money's not here. Well, your money's in Joe's house, that's right next to yours, and in the Kennedy house, and Mrs. Maitland's house, and 100 others.
Banks take money from people who deposit it and use it to make loans and purchase assets. This helps them grow their business. However, if everyone wants to take their money out of the bank at the same time, it can cause a panic and the bank run.
The bank won't give someone their money. Well, I'm going to get mine. Come along, young man. Every penny.
People are wanting their money back from Silicon Valley Bank due to the fact that the bank failed to have their money. Unlike the 2008 financial crisis, when bad and toxic loans were given out to people who could not pay them back. This situation has to do with bonds, rather than loans. Bonds or securities are usually a great asset because they're very low risk and they earn a set high rate of return. So, SVB took people's money and they went and bought bonds at a set interest rate. But as interest rates increased, the value of the bonds that they purchased went down in price. They were less valuable, and normally that's not a problem unless you have to sell those bonds early, which is exactly what happened. Customers wanted to take out more money than the bank was expecting, and so the bank had to go sell those bonds at a huge loss. Means they didn't have enough money for all those withdrawals. And of course, when people heard that the bank might not have enough money, they want to take out more money, and that led to a bank run.
This prompted US regulators to step in with emergency measures, including seizing another bank 3 days later, in a bid to ease fears that depositors might pull their money from other lenders.
The government and the Federal Reserve are trying to reassure people that banks are safe and that there is no need to rush to the bank and withdraw their money. Even though people are insured up to $250,000, it is still not recommended to go to the bank and withdraw their money. This is because the banks do not actually have the people's money. Thanks for tuning in. Make sure to subscribe to stay up to date with Facts In.